Hey, good morning, good afternoon, good evening to everybody. I'm Barry Parker. I want to welcome you to the Capital Link Trending News podcast series. So we have today Constantin Baack, who is the CEO at MPC Container Ships. MPC is listed in Oslo on the Oslo Stock Exchange. Symbol is MPCC. So the company started operations April 2017 and has grown in now to one of the largest, or actually the largest, container tonnage provider in the intra-regional trading routes. So the fleet, 64 vessels, and the total capacity is, I think it's approximately 138,000 TEU. So you get the idea. These are smaller ships. These are ships that are 1,500, 2,800, 3,500 TEU, kind of those sizes. Today's discussion, we're going to talk about how shipping generally and MPC specifically is getting ready to gear up for the upcoming environmental regulations, and what this means for fleet renewal and fleet maintenance. And we're also going to talk about options regarding the existing fleet and new builds. So just before we started, I was just remarking, everybody came back from the summer holidays, and suddenly 2023, when the new regulations are going to kick in, is, it's 3-4 months away, and all of a sudden it takes on quite a bit of urgency at this point. So let's start the questions. So we're a few months away. As we're recording this, we're about 3.5 months away from the new regulations coming in. So it's a question about the industry generally, and then for MPC, just how do you, Constantin, what impact do you think these regulations are going to have, and are the majority of the owners out there ready for them?
Sure. Hi, Barry. First of all, thanks for having me here on the discussion, and looking forward to running through a few interesting topics. And to your question, I mean, in general, looking at the container industry and MPCC in particular, I can start with us. Yes, we are ready. The MPCC fleet will be fully compliant with the new EEXI regulation that will come into force early next year. But when you look at regulation in general, it really depends on the type of regulation, because EEXI is obviously only one leg to it. There's also the ETS, the EU ETS, where we have still quite some regulatory gaps in our view, and uncertainties do prevail. And we believe there's a need for a more global regulation rather than a EU regulation as a starter. And the regulatory bodies should align regulation. And the goal should be no patchwork of regulation. But that remains to be seen. That scheme is yet to be finalized, but it's certainly another very relevant aspect. Furthermore, when we look at the CII, for example, there is no BIMCO clause available so far for CII regulation. Nothing for 1st of January, obviously, but down the road, very relevant and tangibly relevant. So that is very important from my perspective. And if I may add, I mean, focus on the impact of the regulation, which I think is very important as well. We expect that in many trades, vessels will actually have to reduce speeds, and we will see significant speed reduction and turn towards slower steaming in order to be compliant with the upcoming regulations over the course of the next couple of years. Again, not as of 1st of January next year, but in the course of 2023, 2024, 2025, we do expect that will happen. And obviously, to be compliant, liner companies, in particular in the container segment, they will need to reduce speeds and or add additional vessels into their service offering to cope with the schedule. So a global speed limit is, in our view, something that will implicitly be imposed by the new regulation. And we expect that to be especially significant for intra-regional trades due to the trading pattern, more port days, different vessel designs, etc. So that's very important. And we looked at various trades and analyzed them, in particular in the Caribs, for example, in the Americas, where you go rather fast with high reefer container intake. We expect the impact to be up to 10% of of reduction already in 2024. So all of that is kind of a bit of an overview on what we expect. I think overall the industry is kind of ready. Certain regulatory aspects are not yet detailed out the way they need it, but on EEXI, I'm confident as of early next year, we will be compliant and most of the industry will be.
Yeah, don't rush us. We have 3-4 months, so we don't want to do this 7 days from now. You got a little bit of time, but it kind of leads us into the next question that I had. You started to talk a little bit about going beyond 2023. If you look at 2030, the regulations are going to become stricter over time. So kind of the same question. So looking 7 years out, I mean, are people ready? Is the industry ready for that? And then sort of in a broader sense, what are ship owners going to do, for upgrading? And then, I'd ask the question for MPC in particular. I mean, I think one topic is obviously alternative fuels. So, I mean, I'd phrase it by 2030. Do you think the industry is going to be ready for alternative fuels, or are we still going to be talking about the slow steam mode?
Yes, all very relevant topics, and I think it's obviously a snapshot analysis that I can run us through in this discussion, but there's a lot to be talked about, and I think more generally, the new regulation will in any event trigger increased retrofitting of older conventional vessels, and certainly prioritization of, let's say, carbon neutral or zero carbon new builds. We'll get to that later on, because one part of the answer is how do we deal with the existing fleet, and the second one is what does that trigger in terms of need to replace tonnage and what form and shape. So I think in general, I mean, the global fleet is quite old, in particular and very pronounced in the smaller sizes below 4,000 TEU, for example. 66% of the fleet on the water is above 15 years of age. So that gives you an idea of also the need for replacement, and also the way the new regulation will in all likelihood affect that part of the market in particular. So quite a number of vessels in that size will have some challenges, or at least the need to do something in terms of retrofitting in order to cope with the environmental regulations. Scrapping has basically come to a stop over the last 2 years, given the market dynamics. I expect that to pick up somewhat, but at the same time, we do need more vessels. We do need more modern vessels. The reduction of speed will again consume capacity, will have an effect on the supply side, in particular in the container market, where we have round voyages and clear schedules that will lead to the need for more tonnage. And at the same time, looking at the age profile, as I've discussed, there will be replacement needs, in particular in intra-regional trades, by virtue of the type of vessels, age profile of the vessels, and frankly, the very limited order book, at least for that part of the market. As you know, the larger tonnage dominates the order book, and the smaller sizes do not really, are at least not really high in terms of order book to fleet ratio and order book in general. So I think that is very important to consider when looking at, let's say, the first goal line, which means 2030 IMO goals, and how we deal with those.
Well, let me ask you a related question, kind of a more pointed question. So if you were ordering a new build today, and a new build would have a useful life of 20, maybe 25 years, I mean, how comfortable, if you order it today, would you be that would not, suddenly be obsolete?
I think more generally, if one was to opt for new builds, and we have ordered some new builds, and I'm happy to elaborate on that in a minute, I think it's about optionality, because the fuel supply is uncertain. I mean, on the main lane trades, if you look at the large vessels above 10, 12,000 TEU that are on order, at least the ones that have been placed over the last 1-2 years, most of them are LNG dual fuel. Why is that? Because it creates optionality, and the LNG infrastructure is at least out there, right? On the mainland trades, you have Singapore, you have Rotterdam, you have only 4 to 5 port calls on some of the main lane trades. You know where the ships can bunker, and you have a, let's say, a reliable trading pattern. You know where these large vessels trade today, tomorrow, and the day thereafter. It's a bit more nuanced if you look at the smaller vessels and the intra-regional trades, which, by the way, in terms of number of vessels, 50% of the global fleet in terms of number of vessels is actually below 5,000 TEU and is operating intra-regional trades. So we should not underestimate the relevance of this, in particular when it also comes to fleet renewal, purely by the number of vessels. So that is very important. So if I was to order, and we have placed 2 recent orders in July, we have opted for dual fuel methanol main engines. So we have the optionality to run on MGO and or on methanol, green methanol for that matter, and once that fuel is readily available. And we believe that is the right way to go about it. The additional cost associated with opting for a dual fuel setup is probably 10-15%. And we have done that against a long-term time charter, 15-year time charter. And that is the way we believe, we can move forward on the new build. So it's about maintaining flexibility, optionality on the fuel side, whilst at the same time also having partners with whom you can build that on a long-term basis with the respective cash flows against it. And let me just make that additional comment, and that is by those 2 vessels, 2 1,300 TEUs that we have ordered trading Rotterdam, Hamburg, and then up the coast of Norway, we are establishing the first green transportation corridor in Northern Europe, and that is something we are quite excited about, and we have found the right partners to execute on that. But again, the fuel supply globally is a big question mark and will remain a big question mark for the foreseeable future in our view. Therefore, to opt for certain trades where you have high visibility and high understanding of the trade is extremely important and critical.
So part of your green corridor, then you'll within that you're comfortable there'll be the supply of methanol in the ports that you're calling at.
The methanol will be available to maybe not 100% green, right? I mean, the question is when will enough green methanol be available? But you can also blend green methanol with other colors, be it blue or gray methanol. And we think that is the way. It will be a transition. It will not happen overnight.
Sure. Yeah.
That the whole world is green. And for us as a tonnage owner, we have the same, let's say, economics, whether we initially run on MGO or on green methanol. We are a firm believer that in certain regions of this planet, green methanol is a very viable solution. Whilst in others, it might be LNG dual fuel on the mainland trades or in the Americas, for example, where you have a different price differential going forward. But we believe, it's worth exploring alternatives and options with partners. And in this case, we have combined not just a charterer, we have also commitment, a long-term 15-year commitment by cargo owners in the container space. And that is very unusual to have a link between the owner, ourselves, the charterer, and effectively a contract of affreightment on the container side, which on a 15-year basis is, I would even argue, unheard of in the container industry. And I think combining those elements, which is nothing that you can do overnight, ordering a container ship these days has been way more complex and will continue to be more complex going forward than 10, 15 years ago.
Well, it sounds like it. Well, we talked about the new build side. Now, a few minutes ago, you mentioned retrofitting. Has that been part of your strategy? You explained how you're thinking about the new builds, but you do have a big fleet. Have retrofits come into your discussions internally at all?
Yes, absolutely. I mean, we have ongoing dialogue with quite a number of our customers. Obviously, retrofitting in general goes hand in hand with our partners, right? And that means we are looking at all kinds of, starting with paint over certain piping, over bulbous bow modifications, propeller modifications, and I think there is more appetite by our liner customers has evolved over the last couple of months and quarters to really opt for certain measures. And we are in active discussions and actually rolling out a few of these measures as we speak in order to make the vessels, let's say, more attractive. And that starts with silicon pans, VFD pumps, LED lights, and as I said, retrofitting of propellers and bows, or shore fitting, meaning electricity, shore electricity. So those are all measures that we are working on. It will not make a second-hand vessel fully green, but it will certainly help the transition and is necessary in our view.
But I think it's important what you're saying. It sounds like you're doing this in conjunction with your customers. You're not. It's not just you and your engineers sit in a room and say, "Okay, we're going to do this." It sounds like you have the other stakeholders involved in it.
Yes, that is true. But again, it also depends on the level of engagement. On the one hand, I think that this has more recently received a bit more traction. We have seen a bit more traction. We are obviously, with our fleet, we have 64 vessels on the water and 4 new builds. We have a very constant and good dialogue with our main customers. So a larger fleet is certainly beneficial in order to engage into these discussions, and it will go hand in hand. I mean, it's the benefits of lower consumption is also for the liner. So there will be a give and take in terms of who carries out the investment and what is the actual also payback from a pure economic standpoint. That is something that we obviously focus on quite a lot as well. But we see that that has really merits and is something that we believe will continue to be a relevant topic for the existing fleet. And in fact, also a very important component in the green transition, in our view, that we do not forget and keep a life cycle approach on assets. We do not forget that the vessels on the water will need to be considered as well, and will take a significant role in the transition into a then also a decarbonized and more efficient environment.
Okay, well, that kind of leads us. We're not going to talk, a lot about the financial side, but I think, in view of what we're just talking about, it's just worth a question about how you're going to your plans for funding. The renewal of the fleet, expansion of the fleet, and how it fits in with your overall capital allocation policy of the company.
Sure. I mean, we are in a market environment. We have a very strong backlog of contracts, which is quite comforting. I mean, we have 1.8 billion in revenue backlog, 1.4 billion in kind of projected EBITDA backlog. We have a very clear priority and have communicated that and have lived that year to date already, of a focus on distributions and returning capital to investors. We have year to date declared and or paid around $350 million in dividends, which is significant if you compare that with a market cap of around $1 billion. And that is the clear priority in this market environment. Having said that, based on our backlog, it's not that we need to decide on whether to pay dividends or deleverage or do new investments. We're actually in a comfortable situation that we can cater for all three. The clear priority is on returning capital investors, but at the same time, we are looking at currently end of last quarter at a net debt position of 100 million versus a mark-to-market value of the fleet in excess of 2.5 billion. So we have a very low industry low leverage, in fact, and we will continue to deleverage the, let's say, more vintage part of our fleet going forward. We will consider levering up some of our new builds, of course. We believe, given long contract coverage, that is something to be considered. But we also believe on the existing fleet, rather deleverage and in parallel to a significant distribution policy. And last but not least, and that is documented by the new buildings that we have carried out this year, and also by the fact that we have also sold 4 second-hand vessels year to date. I think from a second-hand vessel standpoint, it is more time to consider divesting some of these vessels and renewing the fleet, but not at the expense of the dividend. So if you look at our dividend policy, and that differentiates us quite significantly from others in the industry, we are going to pay out a recurring dividend as one leg of our policy by paying out 75% of net profit. and that is net profit and not free cash flow like most of the other companies do it, because we want to cater for the fact that, if we add new buildings, that doesn't have zero impact on the distributions in the short run, because the payments to the shipyard go through cash flow and balance sheet and do not have any impact on the P&L. So we will maintain a significant dividend, and that is also a very important part in our decision making when considering new builds. But at the same time, we still have enough capacity, given our very strong balance sheet, to also renew the fleet over time, and possibly even consider certain vessel sales, which then is the second leg of our distribution policy, being event-driven distribution. So every time we sell a vessel, we pay out up to 100% of the proceeds, whether that's 50, 75, or 100 is then to be decided. But we have a very strong priority on distributions at present, without compromising on selective fleet renewal. The emphasis is here on the word selective, and obviously deleveraging the balance sheet further.
Oh, you're in a great position. Some of the numbers that you're describing. So I want to just close it out. I mean, your ability to continue with the strategy you've described. So it depends on on the market, and it sounds like it's a very, very strong market. The regional trades that you're in. So let's just finish it off. Just if you can talk about the development of the market to date, and over the next few years. I mean, you mentioned that huge projected EBITDA number. Just how you see things evolving over the next couple of years.
I mean, obviously, the overall macroeconomic and geopolitical situation is everything but easy, and of course also difficult to read, as it is characterized by uncertainty, which in turn affects behavior of market participants in the industries, but also obviously on the capital markets globally. So I think that sets the scene for the outlook on the market in general. Having said that, we are presently still in a historically strong container market, which is a bit easing off, certainly on the freight market, where we see, despite a notable, let's say, decrease of freight rates, we still see way stronger levels than pre-COVID, right? So I think that's always, it needs to be considered that we shouldn't benchmark that with the first half of this year. We should actually benchmark it with the market over the last 10, 15 years. And there we are still, even from a freight market standpoint, in a very good condition. The liner companies, our customers, I mean, book record earnings at the moment. I mean, that is expected to go down. I expect that to go down. But I mean, currently it's single-digit billions per quarter, the main liners. I mean, this is very significant money. So pretty much all of the top 10, 15 liner companies have a net cash position at the moment. I mean, that is unheard of in the industry. So I think overall the industry is in a very good shape. And when it comes to the charter market, which is obviously particularly relevant for our earnings, the market has also taken somewhat of a breather. However, our segment of the container market remains robust at elevated levels. I mean, the last fixture we have communicated is roughly 2 years for $42,000. So that is, compared to the first quarter of this year, probably a slightly shorter period and a softer charter rate. But it still means, we are securing roughly 30 million in revenue backlog on one ship alone. So I think this is still a multiple of pre-pandemic levels and should be considered as such. So it's a question of benchmark, especially because available tonnage remains very, very limited, especially going forward. So probably congestion will obviously smoothen over the next couple of quarters. But then we have the regulatory aspects, as we discussed earlier, that will inevitably lead to slower speeds, and hence will have an effect of capacity. So there's congestion easing versus new regulation kicking in. It remains to be seen what that exactly means. But on a net basis, or certainly the regulation will lead to slower speeds, that I'm extremely certain. And overall, I do expect, we are as a company very well positioned with our backlog, with our low leverage balance sheet, with our focus on intra-regional trades, where we see tremendous opportunities when it comes to projects to decarbonize the industry, like we have done with establishing a green corridor in Northern Europe. So we are excited, and we do that out of a position of, only selective growth ambition, a clear commitment to dividends, yet a very strong balance sheet. And we are actually excited about that, despite, let's say, all the macro uncertainties that are out there.
I think it's a very good, it's a very, very good outlook. So I think we're gonna finish it off. So I want to thank you, Constantin, for coming on. Great to talk to you, and maybe we'll do this again in a few months, and we'll see where we are as 2023 comes around. But it's a very, very, very good outlook. So thanks for coming on. So
thank you, Barry.
Yeah.
Thank
so
you.
we'll conclude this. So it's Barry Parker for the Capital Link Trending News podcast. So we're signing off. Constantin, see you later.
Thank you, Barry. Take care.